Hello and welcome to another educational web seminar brought to you by Truck Writers in partnership with Concept Financial Group, Factoring Freight Invoices 101, presented by Sean Sullivan and Chris Johnson. Now a few things about our technology before we begin the webinar today. Your lines have been muted for the duration of the webinar. You can use the arrows to minimize the menu and enter questions into the chat panel to your right, but do not click the black X or you will exit the web seminar. Now a bit about our speakers. Sean Sullivan is CEO of Truck Writers. He's been a risk manager and insurance agent for over 30 years. He was elected board member of the Minnesota Trucking Association and received their President's Award in 2013. Chris Johnson is president of Concept Financial Group. He's an expert in transportation finance and an active member of several transportation associations. His company is also an active member of both the American and International Factoring Associations. Without further ado, I give you Sean Sullivan and Chris Johnson.
Okay, thank you for the introduction, Andrew. Chris, welcome.
Welcome. Hello, everybody. Thank you for sharing your time with us today.
All right, in respect for everyone's time, let's get rolling. Chris, what exactly is factoring?
Well, Sean, in the most simple way I can define it, factoring is selling invoices for cash. So like the ATM on your screen is, visualize that machine where you simply put in the invoice and out spits the cash. Okay, that's it. As simple as that. And that will conclude our webinar today. Thank you for joining us, everybody.
Okay. Chris, wait a minute. Sit down. Sit back down.
Okay, sorry.
Okay, there's got to be more to it than that.
Well, okay. And contrary to what you think, Sean, no, I did not invent factoring. But the history of it goes back to, it's one of the world's most oldest methods of financing, dating back to the early days of civilization. Back when trade was going between the colonies and the United States, the timber, tobacco, cotton, it was a way to facilitate those transactions taking place. Then from there in the 70s and 80s with banking regulations and high rates, factoring also then became more prevalent. And then from the 90s on, it's become mainstream. Many large banks and large financial institutions have factoring arms. Besides trucking industry, which I believe most of our listeners are a part of, it can be found in most industries. Any business with a reliable client and an invoice could factor.
Okay, thank you. And just for the record, Chris, I never ever thought you invented factoring.
Oh, okay.
Okay, so factoring companies are also known as factors. So how many factors are there?
Well, in the U.S., there's hundreds of factoring companies across the nation, from the large bank affiliation to the one-person shop who's got just a pool of money and he or she does small ticket factoring. It is a worldwide factoring. The International Factoring Association is a worldwide organization with members all across the world.
Okay, you mentioned earlier the word bank. I have a question. Is factoring regulated like banks are?
Well, no and yes. I mean no in that there currently is not any government regulation like in banking specifically to factors. Yes, in that for the most part, factors do a great job regulating themselves. There is a group, the IFA, which I just mentioned, the International Factoring Association, that most factors are members of, and that organization has rules of ethics that we all follow.
Okay, thank you. Let's talk about the different types of companies that might factor. Isn't factoring only for companies who are about to close their doors?
Well, that is the old perception, as you can see there, and versus the new perception. Those old negative connotations, I can source them at two places: cost and customer perception. When I started in this industry 17 years ago, the old school perception maybe was somewhat that you were financially weak or on your way out of business. But nowadays, it's just a normal means for you to finance your operation. As banking regulations get more strict, it makes it harder for businesses to get loans from banks, to qualify for banks. So in that regard, factoring has even become more mainstream with that. And then, so secondly, the costs. The perception was that factoring costs you a lot of money. And over the last, 15 years, the costs have definitely come down. And it's because of competition. There just is more competition, and more competition will bring costs down. And then secondly, technology. There's improved technology which just make things more efficient, again bringing costs down. Factoring was a $215 billion industry now, and maybe not even 10 years ago it was half that. So it's just a mainstream way of financing your cash flow.
Okay, so as I understand it, factoring is actually the sale of an invoice then, it's not a loan?
That's correct.
Okay. Understanding that factoring is widely accepted in the marketplace, why would I choose to factor?
Well, okay, as a business owner, you need cash for working capital. So I see 4 places the business owner could look to: their own personal funds, family members, or an outside investor, a bank, or a factor. Well, it's not going to take long for you to use up all your personal funds. And then secondly, do you want to have a family member, an outside investor, coming in and taking control of your business? So that makes you look to a factor or a bank as the next place to turn to for cash flow.
Okay, thanks. In regards to working capital, what's the difference between a bank and a factor?
Well, okay, let's go with a bank line of credit. So a bank line of credit is just like it sounds, a bank line of credit. And it's a great way for you to fund your working capital. And if you're a business owner, it's the first phone call or visit you should make is to your local banker. If you're a business that's been around for a long time, good credit, no concentrations, I mean, those are what banks are looking for. It's a great, inexpensive source of funding for you. However, on the flip side, banks would have more requirements, more regulations that make it hard for small or new operations to qualify for a bank line. Banks are extremely slow in making decisions, which is difficult for a growing company. A factor would have less restrictive agreements. There are probably no covenants, no restriction on owner distributions, no financial statements needed. All those things would be needed by a bank. I can kind of sum it up in this way, which I've learned is factor, and I say this respectfully because I was a banker for 10 years, but factors are typically business people who look at growth and future growth to make credit decisions, while banks tend to base credit approvals on the past, historical information that may not be relative to your future growth. Like, I always remember this. One of my old bosses told me this once. Mark Twain quote. He said, "A banker is a fellow who lends you his umbrella when the sun is shining, but wants it back the minute it starts to rain."
Okay, that's a great saying. Let's talk more about the reasons that a business may want to factor its invoices.
Okay. So, well, we'll just go in the order here. It speeds up cash flow. Factoring provides you fast and reliable cash flow. You deliver the load today, you know it's factorable today. You have payroll due on Friday, well, you can plan forward because you know what your incoming money is going to be for the week. Otherwise, you're just, you build out to the debtors and you're just waiting for them to pay. Is the check going to come today? Is it going to be next week? Is it going to be the week after? Factoring also, many clients benefit from the credit checks and collection efforts. As your partner, a factor would be, you're thinking of hauling a load from a company you've never heard. You call your factor and say, "Have you ever heard of them? What do you show credit for them?" The worst thing for you is to haul a load and never get paid. You'd have been better off just sitting home watching Magnum PI that day or something like that. So factoring provides, in a way, a complete package. So it gives you the working capital financing, it gives you credit risk protection, bookkeeping, and the factor is doing the calls. The factor is not a collection agency, but they are making the phone calls in a professional and courteous way. 80% of new businesses fail from lack of cash flow, not lack of sales. So you got to have cash.
Okay, you used the example when we started of the ATM machine. Could you talk a little bit more about the factoring process and how it actually works?
Okay, so the process would be, well, first before we get to this, there's an approval process. So the approval process is pretty simple. It's, it can be on a factor's website where you just put in a few key information about yourself and maybe some of your clients. So once you get through that, then you discuss the terms, sign the documents with the factor. Now, all that stuff could happen in a day, 24, 48 hours. So it is a quick process. So once all that's set, now you're set. Now you can just move forward. You won't have to do any of those documents again.
What should we really look for in a factoring company?
Well, okay, let's just go by the list, I suppose. Okay, flexibility. So you're looking for flexibility. You want a partner that's flexible. Your business changes. Something happens tomorrow that you didn't expect. Well, you need to be able to call them and explain to them and work through it and figure it out together. So that's you want a partner that's going to be flexible and understand those things. Minimum volumes. What a minimum volume requirement is, and it is common. I do see it, but say you're 10-unit account and you're promising that the factor is going to purchase $100,000 of invoices each month, and which would generate an X amount of fee for the factor. Well, then the factor is going to have in their contract that minimum volume amount, which, so then like next month, say it goes down, you're still paying the factor the fee. So I would watch for any minimum volume requirements. Initiation fees, those are just like they sound. I mean, for a factor to set you up, their real costs of their own is minimal. It really is. If someone's charging a $100 initiation fee or something, that seems reasonable, but there really would be no reason for any initiation fee. Termination fee, again, it's along the same lines as I think it's in your best interest to have no termination fees in your factoring arrangement. Recourse versus non-recourse. Okay. The difference between recourse and non-recourse is recourse means that at a certain point in time, so say for example 90 days, at 90 days this invoice would be charged back to you. So the factor purchased the invoice today, it's 1 day old, 90 days from now the factor still, he or she has done their professional collections, but it hasn't gotten paid. So at 90 days they would look back to you and say, well, we need to charge this back to you. So on your next batch of invoices you sent, I would be deducting that non-paid invoice. Non-recourse means so once the factor purchases it, whether it gets paid or not, the factor holds it. They don't charge it back to you. Now, to continue on with that, because it is a big subject, the non-recourse factor will charge you more. And the non-recourse factor typically will have, you just need to read your contract, because there are many exclusions that in a sense provide them the opportunity to essentially charge it back or turn it back to you. So if I prefer recourse versus non-recourse, just from your perspective, I think it's better. And I mean, I've been doing this for 17 years, and to think of how many invoices have ever gone over 90 days for the volume we purchase, it's just not, it's not worth the extra payment you're paying the factor for the fee on the non-recourse. Integrity, reputation. Do a simple Google search. Are they a member of IFA? Are they Better Business Bureau? The internet has lots of information to see. Customer service. Everyone says they do this, and it's important because if they're not giving you good customer service as their client, how do you think their customer service is going to be with your client that they're calling? And they have, contact with your clients, and if they're giving you great customer service, then you would expect that it would go on to the service that they're giving your clients also.
Okay, I appreciate that, Chris. What are some things we should watch out for?
Okay, good. Watch out for hidden fees in your in the proposed contract that you're looking for. The long-term contracts. Most importantly, just read, and if you don't understand something, ask questions. If you still don't, then ask another question. It's like I said, Sean, it's simple. That ATM machine that I described in the beginning, it's simple. You needed to know a lot more, so that's why I've explained more than that, but it really is simple. A factor that's trying to make it more complicated is probably not a good partner for you.
Okay, Chris. Well, thanks again. I really appreciate that. I'd like to go now back to you, Andrew, for questions that our viewers might have.
Excellent. Thank you very much, Sean and Chris. That was a very informative webinar, and we have a few questions that have come in, so let's dive right into it. Our first question is, if I decide to start factoring, how easy is it to stop?
Well, my first response would be, it depends on your own cash flow, and because you still need your cash flow to flow, so you need to make sure you have that plan in place on how you are going to cash flow it from there. Maybe the bank's giving you a line of credit, or now you can fund yourself. One of the best examples that I've seen how this works is a client has 25 customers that they factor, and they decide over time, let's keep 5 of them in-house. So okay, they keep 5 in-house. Then maybe they decide to keep another 5 in-house, and then 10 in-house, and then eventually there's 5 left that they factor, and then they're cash flowing and everything's going great, and then they just say, let's just pull all these in-house and stop factoring. But something again to discuss with the factor prior to signing up with them, and that's it.
Very good. Next question we have is, I am concerned that the factor would tick off my client. We spend a lot of time getting these customers and are concerned with anything that could damage that relationship.
It's a great question.
It is, yep. Professional factors understand the importance of your customer, and they're great in having positive relations with your client. It's certainly something you need to consider because factors will have substantial contact with your clients. But many debtors already pay third parties. Walmart, for example, has an entire department that deals solely with factors. So in all my years, I cannot recall seeing this as an issue.
Very good. The next question we have is, what happens if the invoice never gets paid?
Well, again, that goes back to the recourse and non-recourse discussion we had. If you're with a non-recourse factor and there's no problems that they've identified, then it's their problem, not your problem. If you're with a recourse factor, then it would get charged back to you on your next batch of invoices you were submitting with the factor. So say you had a $1,000 invoice that wasn't getting paid, the factor would be charging it back to you. Now, let me add that you're not going to just find out at 90 days that it's not being collected upon. You will be involved in the in the process all along, so it will be no surprise to you that it is going 90 days. And the factor will have a good reason to charge it back because they don't want to charge it back. They want to get paid. So they are doing their best professional, courteous collections to get that paid.
Excellent. Another question, is this a long-term deal? What if I have cash crunch now that I know is only temporary?
Well, no, it isn't necessarily a long-term deal unless you've signed a long-term contract. But otherwise, no, it can be, again, it's part of the negotiation and process and due diligence on your part as you're looking for a factor and doing your due diligence on them. You don't want a long-term deal, and you do have a cash crunch. Here's a good time to talk about this. So say you have a debtor that is your main debtor, and they have a high volume with you, but you want to factor them like this time of year, but then other times of year you don't need to factor them. And that can work, but the only problem with that is the debtor, that once you sign up the debtor with the factor, now the debtor is going to pay the factor. So there's been a process that goes along between you and the factor and your client to get that all changed over. And it's just wise to be sensitive to your customer, because they don't want you then 3 months later saying, nope, no, those invoices now need to come to me, not to the factor. They just, in my experience, the debtors just don't like the changes. They, once you set them up, they like it set up, and if you're going to take them back, then just take them back.
Very good. Another question that's come in, what will my customers think if I use an invoice factoring?
Well, I think back to my main comment earlier about just that it's become a mainstream means of finance. I mean, Walmart, like I said, has a division specifically to deal with factoring companies. Some factors will market that this, in a way, signals that your company is actually more financially stable. And there's some, I can understand that, where that would be helpful. Your clients want to make sure that, okay, they hired you to haul a load. They want to make sure that you're financially sound enough to, once you pick up the load, to be able to deliver to the load. So I guess my overall would just be, it's something to consider for you. It's also a reason to make sure you select a good partner, and I guess that's it.
Excellent. Well, that's all we have time for today. If anyone who's attending in the audience has more questions or would like more information from Sean or Chris, the contact information has been provided on the screen here. It will be available on the TruckWriters website, truckwriters.com, and reach out to either of these fine gentlemen for more questions. Thank you very much for attending. This web seminar is now ending. Have a nice day.